Coming up, investors on US election watch. Westpac posts a $7 billion profit, and what are we spending on streaming services? We'll have the details next. It's your daily 10-minute business and finance news wrap for this Monday, the 4th of November 2024. The Australian share market rose today by 0.6% ahead of various rate decisions, corporate profits, and, of course, the US presidential election. George Boubouras from K2 Asset Management spoke with me earlier to find out, firstly, how markets are preparing for that election.
Ricardo, $1 million question. Obviously, this is a record election year globally. Most elections that ever has happened, around 77. Half the world's population has gone to an election this year, but it's all about tomorrow, the 5th of November on Tuesday. The way markets are conditioned for it is that they've been happy with the reporting season. They've been happy with the direction of earnings. They've been broadly happy with the direction of the US economy. But let's make it very clear very quickly. The similarities between both a Harris camp and the Trump camp is that the continuation of some form of tariffs against China will continue. They started in 2016 with the Trump White House, and it was accelerated under the Biden-Harris, and that's because China's been very successful in the export sector, but it's obviously subsidized, which is creating these trade wars. So that's the similarity. Take a step back. A Harris White House is more of the same, a large government footprint as fiscal stimulus, and with the Trump camp, it's all about tax cuts. And obviously, both will have to be funded somehow, but tax cuts versus the bigger government footprint is probably the largest difference you would see.
Okay, so given that, we've got the FOMC meeting later this week. I think that meeting was actually delayed by a day to accommodate the US presidential election. Are we still expecting an interest rate cut there?
All the information to continue with an interest rate cut, say 25 basis points, is available. So the FOMC, if they were to go down that pathway, would not be much of a surprise. They're starting to get the rewards of their core inflations under control, notwithstanding it's been a resilient US economy. Having said that, if they don't go this week, the direction of interest rates are downward in the US, but most importantly, they're not going to go back to the levels and those low levels we were conditioned for in the past. There'll be a shallow, elongated interest rate cut cycle in the US, and that means currencies that are pegged to the US dollar in Asia and the Gulf states will also get some interest rate relief.
That's interest rates this week. If we factor in now the US presidential election and the potential for stimulus, as you mentioned, with tax cuts and the like, could this have an impact on future interest rate moves if, for example, you do see some of these stimulus translate to inflation in the States?
Exactly. So what the market's quickly doing is, with the tax cut narrative of a Trump White House, they'll say that is unfunded. The FOMC then you would expect will sit back and watch how that plays out. And they call that the reflation trade. So it's been happening in the past 6 weeks. They call it steeper yield curve, but a reflation trade. With a Harris-led White House, it's not so much a tax cut again, it's a bigger footprint on government spending, and both have to be funded, but one they're saying is more inflationary, the Trump scenario.
Okay. We've got a corporate reporting season coming through also in the US, as you previously mentioned, especially from the major tech names. What's that saying about the health of the US economy?
The resilience of the US economy has permeated, and it's continued for a number of years. It's been reaffirmed with the such tight interest rate hikes that we've had in the past 2 years in the US. It's withstood that headwind, and the resilience is passing through in earnings, expanding earnings. They have fallen, but they're still positive, and it's passed on to the mid-cap sector in North America, and anticipation of that to continue in calendar 2025. So it's holding up, notwithstanding those rates have been high. Another quick one to point out is that while interest rates have started to be cut in the US, the cash rate, the mortgage rate's actually higher from where they were 1-2 months ago, because in the US, their mortgage rates are off the 30-year bond yield, and bond yields in the long end are higher. Therefore, surprisingly, US residents are paying more for their mortgage over the past 2 months than they were earlier this year.
Talking interest rates earlier, the Reserve Bank of Australia meets today and tomorrow. What's the market anticipating?
A change in language, no change at the RBA level. Remember, we've got that fall in inflation, which is good, and you reported on that mid last week. But the core inflation is always about that core. The economists are looking at that direction. It's 3.5 on that annualized number. It needs to get to 3 or under. So the language will be tweaked, but the 4.35% cash rate will persist until February, March, April, until early next year, given that core inflation, because fiscal stimulus in Australia has been a larger part of our GDP relative to other economies over the past couple of years at the federal and state level. So that persistent core inflation, it's lower, but it's not low enough.
Okay. I think the big corporate story of the day in Australia has been Westpac's $7 billion full-year profit. What do you make of it? And what does it say about the way the consumer and borrowers are coping with higher interest rates?
Yeah, so very quickly on the full year number for Westpac, just under 7 billion for the fiscal year. It's about 3% lower than the previous fiscal year. The thing to reinforce is that costs are higher. The profit's quite healthy, but again, a little bit lower. There's a resilience to that earnings, that margin, the net interest margins is a little bit lower, but it's coming through. It's a good disciplined set of accounts for Westpac as it hands over to a new CEO, Anthony Miller, later on this year. And the thing to reinforce here is that they're not really, this is an overgeneralization, but Westpac are not chasing the mortgage market and discounting aggressively. They're sitting back to maintain their margins relative to their peers. And the other outlier was that their treasury group seems to have done a good contribution to earnings relative to expectations. That may be at the cost of ANZ, given the issues it's had in the past 6 months. But in general, it's been a very disciplined set of numbers for Westpac, and it puts it in a good position to maintain the contraction of net interest margins, which the big 4 banks are dealing with in Australia.
And finally, George, where do you see the opportunities for investors right now?
Beside the volatility this week with the US election, just sit back. It's very behavioural. At the end of the day, there is a resilience to global GDP. The China stimulus and the lower rates for the US for the year ahead means that GDP globally will be revised higher 6 months forward. That is good for earnings 6 months forward in the diversified portfolio.
That is George Boubouras there from K2 Asset Management. Now to our feature interview of the day, and the rising cost of living has seen more Australians splashing on at home entertainment as many trade a night out for a night in, and that's based on Deloitte research, which found the average monthly outlay on subscription services rose from $57 to $63 this year. And that's despite a 10% fall in consumption overall, which obviously includes music, sport, gaming, video, and other media subscriptions. For more, Rhayna Bosch spoke with Deloitte partner Peter Corbett.
In 2024, I think what we saw is a reaction to perhaps an increase in cost of living, but perhaps not in the way that you would expect it. So we saw that actually consumption of media on average at total level was down 10%. But people actually held on to the number of subscriptions that they had. So last year in 2023, the average number of digital entertainment and media subscriptions was at 3.2, and in 2024 it's at 3.3. But what we've also seen is that spending is up. So actually it's up about $5, which is about the same as the price rises that we've seen across all subscription services. So it looks as if that in 2024, people are actually a bit like post-COVID. So perhaps spending a little bit more time at home, perhaps watching a little bit less because of the writer's strike in Hollywood and the availability of new content, but happy to pay a little bit more. So perhaps skipping a night for drinks with the friends and staying at home.
Yeah, you spoke a little bit there about subscription services, and that's obviously a key spending item for most people in entertainment. We've also seen the rise of ad-supported services. What are you seeing in terms of people's adoption of those?
Yeah, so Australians still love to get content without paying for ads. So we've seen that in a number of years. So specifically, people tend to, I think it's 56% of Australians in our report said that they would prefer to watch content without ads, and they'll pay to do so. So that's obviously increased. I think what we're seeing is that the number of subscriptions that are being held by Australians is actually holding, partly because of the optionality that exists within each of these subscription services. So you can get different tiers of subscriptions now with ads, and therefore I might hold on to my subscription for a little bit longer.
Now, I've also had crackdowns from places like Netflix. How has that influenced things?
Yeah, look, I think we did look at that this year in the report. It means that people aren't able to necessarily share their passwords as much as they used to with their friends, which probably for generations like Gen Z that tend to be the ones that are sharing, that means that they're actually holding on to subscriptions and paying more this year than they were last year.
Now, you mentioned the generational divide. What else are you seeing there?
Yeah, so what's been interesting in that drop in the amount of content that's being viewed is that actually in 2024, boomers are the highest media consumers across all our generations, which perhaps feels a little bit counter to what you would expect. But what we're seeing is, despite Gen Z pulling back on the amount of content they're consuming, they're still spending 10 hours per week on social, audio, and other digital formats, which is still a lot of consumption overall.
Now, there's obviously a lot going on in the world at the moment between global conflicts and election cycles. What are you seeing in terms of audience trust?
So what we saw overall is that 73% of consumers consider major publishers to be at least moderately trustworthy, though only 17% of them view them as very trustworthy. So suggesting that there's still some skepticism in news sources. That's contrasted with the likes of news published on social media, which 51% of Australians say that it's not very trustworthy, and AI tools is lower at 55% of Australians say it's not very trustworthy. So major news publishers is still the place that Australians tend to go to for the most trusted news
That's Peter Corbett there from Deloitte.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial